One of the very first things we went over were account types. So if you need to refresh your memory, go back to my videos on the accounting equation and types of accounts. Accounts receivable is an asset account which shows the money customers owe us from credit sales. Accounts receivable is the control account, which will show the total amount due to a business, but subsidiary accounts receivable will show what a specific customer owes. This account will reflect what they bought, what they already paid for, and what they still owe. So all of my subsidiary accounts, once they are summed together, will equal my total accounts receivable. So many people use bank credit cards or Apple Pay, but every time a customer uses this, the seller of the goods has to pay a fee. The range of this fee can range from 1 to 5% of sales and is typically recorded as a selling expense. Most sellers allow customers to buy merchandise on account even though it costs a portion of their sales, because this grant of credit will ideally increase total sales. At the end of the day, some money is better than no money. In a journal entry on the seller's books, when the customer uses a credit card to buy a new pair of boots, we will recognize their sale, and for the sake of the scenario, let's say the credit card expense is 3%. For a $165 pair of boots, our credit card expense will be $4.95 taken from our cash that we earned. We receive $160.05 in cash, which we record with a debit. Since expenses carry a normal debit balance, $4.95 to our credit card expense will also be debited, and now our debits equal our total credits. A portion of our accounts receivable sometimes will never be collected from our customer, and that uncollected amount is going to be known as a bad debt. To record a bad debt or an uncollectible amount, a business can use the direct write-off method. This is a known amount that the customer cannot pay back, so on the seller's books, they're going to debit their bad debt expense and they're going to credit the subsidiary accounts receivable. If suddenly the customer can pay back the full amount, then we're going to do the reverse entry where we debit our accounts receivable and we credit our bad debt expense. So a business can only apply the direct write-off method to a subsidiary accounts receivable when they know which customer can't pay back and how much they can't pay back. But when the seller sells merchandise on account, they're going to assume a portion of their sales will not be collected. So they're going to estimate their bad debt and record this with the allowance method. The allowance method is preferred by GAAP because the direct write-off method violates the matching principle. We would estimate our bad debt and debit this expense and then credit a contra asset account that we call our allowance for doubtful accounts. To remember what a contra asset is, think about how it contrasts with the normal debit balance of an asset. So even though it's an asset account, it will have a normal credit balance. This is the first part of writing off a bad debt. This is the portion of accounts receivable we do not expect to collect. To apply the bad debt to a specific subsidiary account, we will debit the allowance for doubtful accounts and credit our subsidiary accounts receivable to write off the uncollected amount. Since the allowance method is estimating your bad debt, we don't just pull out this estimate out of thin air, so you're going to use one of the 3 methods to make a reasonable estimate. The percent of sales method will assume that a percentage of sales are uncollectible. So your credit sales multiplied by the percentage of what the business thinks will not be collected will yield your estimated bad debt. If my boutique made $20,000 in credit sales in the accounting period, but I estimate 4% will not be collected, then I multiply 20,000 by 0.04 and 800 will be the value I debit my bad debt and credit my allowance for doubtful accounts. The second method a business can use is the percent of receivables method. This will take your accounts receivable and multiply by the percent of what you think will not be repaid. We base this percentage based off experience in the market with this customer and our economic environment. Our last method is the aging of receivables method, which is similar to the percent of receivables method. Instead of using 1%, though, we use multiple rates. Depending on how long a receivable is past due, we will estimate how much of it is uncollectible. The longer the customer is past due of paying their accounts receivable, the higher the expected uncollectible amount is going to be. For example, I might estimate that a customer won't pay back 5% of their amount if it is between 1 and 30 days past due. But if my customer is 90 days or more past due on repaying my business, I might estimate that 45% of that account will not be collected. We had briefly described what a notes receivable is in an earlier video. This is a promise to pay a specific amount on a certain day with interest that we will be recording in a promissory note. The maker of the note will promise to pay the principal of that note to the payee of the note on a specific date with interest. If we were looking at a note from the seller's perspective, then the seller is the payee. A note will mature when it is due. So if I create my notes payable to a seller on January 1st and owe the amount in full with interest on April 30th, the maturity of that note is on April 30th or in 120 days. Now let's figure out how to compute the interest that you owe on that note. When computing for interest, we are going to be using the banker's rule, which assumes that a year is 360 days and time will be expressed in a fraction. So in our case, it'll be 120 over 360. So take the principal of your note, multiply by the interest rate, and then by your time that is expressed in a fraction using the banker's rule. And this is your interest. It is the money you will pay on top of your principal for borrowing money from that lender. As the seller, when the note has matured and my customer paid me back, I will credit the notes receivable and credit the interest revenue that I earned. The sum of these two values together will give me the cash I earned from that collected note, and I will debit this account. If your notes receivable extends beyond your accounting period, you will record the accrued interest revenue in the same way you would compute interest, but now your time will only reflect for that accounting period. If the note was promised on December 1st with the maturity in 120 days and my accounting period was to end December 31st, I would compute the interest earned for those 30 days and record this as a debit to my interest receivable and a credit to interest revenue. Once the note matures in the following accounting period and is paid back, we would credit the notes receivable and the interest receivable and the remaining interest revenue that we earned in the second accounting period. The sum of these values will give you the value of cash you earned, which we will show with the debit. Our accounts receivable turnover is going to evaluate the quality and the liquidity of our receivables. By quality, we are defining the likelihood of that account being collected in full without bad debts. Liquidity is referring to how quickly we collect that amount in cash. To find this turnover, take net sales and divide by the average accounts receivables. The average is found by taking the beginning and ending balance of your accounts receivable and dividing by 2. This turnover is showing how often those receivables were collected in the accounting period. Accounting for receivables is pretty easy, and I have no doubt they're going to do great on my free practice worksheet and downloadable study guide, which you can find linked down below. And don't forget to subscribe for more videos on accounting.